So the first approach I'm going to run through is just a very simple hedging and averaging strategy. So let's imagine for a second you've got no RSI, no EMA, and no delay. But a buy or sell, a buy and sell will open instantly. Okay. If price goes up, the buy will just bank. As price goes up, the sells are going to start averaging each other. So we're getting entry subject to your pip step exponent, your lot size, and your lot size exponent is going to affect how these next positions open. For example, if you've got a pip step of 10, it's going to be 10 pips, 10 pips, 10 pips, give or take. The 1 minute candle needs to close, so they're not going to be perfectly 10 pips. It's got like an inbuilt volatility thing based on that, really, because if the candle's a massive candle, your pip step's going to be bigger, which is a good thing. Lot size exponent, if you've got a fixed size lot exponent of 1, these lot sizes are going to be the same. If you've got 2, they're going to double, and everything else in between. So that's what would happen. So obviously no delay, buys will bank. And for example, if this was a scenario, these sells 1, 2, 3, the pullback, they should then close here. Okay. Now, if we add delay, let's say we add a 2 trade delay and we're in an uptrend, we're not going to see buys because the buys are simulated behind the scenes, and those buys are just opening and banking because we're in an uptrend. Unless there's a pullback and then technically that initial sequence is in trade 3, then you would see a buy. You might see a buy around here, yeah. But the sell, if you've got a delay of 2 and it opens on the 3rd position, then you're not going to see these. You're going to have an entry up here and then the sell will bank in that example, yeah. Now, another thing to consider with this is if the pullback happens here, you won't see this sell because this stack of trades in the simulation has already banked and closed. So then your delay counter starts again, yeah? So this can work really well, even without RSI and EMA. I've got quite a few settings and approaches with just using delay, yeah? Just using hedging and averaging, just using delay. Because technically as well, you could argue delay is almost similar to an RSI thing as well, because if you've got overbought and oversold conditions, well, if you're running a delay, price is probably going to be in them overbought or oversold conditions anyway. So that's an interesting concept. So what would you optimize in this? Well, you're optimizing delay numbers. You could start from 0 to 14 with a gap of 2. You could have varying different levels of pip step exponents. Normally this is a lower lot size approach and maybe a lot size exponent because you're going to be entering trades earlier, probably. It depends on the delay though. So you almost want to look at a wide spectrum here, because if you've got a really high delay, you're going to have a bigger lot size. If you've got a short delay in a tight pip step, you're going to want a smaller lot size because those positions might build. This is just a little bit of logic that you're just going to have to consider when you do it. So that's hedging and averaging.